Welcome to another video. Today in this video we're going to be talking through the weekly macro themes report from a couple of weeks ago, and the topic that I wanted to focus on for this video is, here we go, the VIX drivers. So it was topic number 3 in this report. This report, by the way, is the service that we provide to mostly institutional investors and portfolio managers, so that just provides a bit of background for that. The bottom line for this one is the VIX has diverged to the downside versus all the key drivers that we monitor. This, along with the sentiment readings, would suggest an elevated probability of a VIX spike. Now, in terms of what that means, really that's just a conclusion based on these charts, and it's worth going through these charts in a bit of detail and talking through exactly what we're looking at here. So the first one here is a couple of different models, well, 5 different models actually. These are all single factor models, and essentially they have been used as such because in the past they've had a pretty good link with the level of the VIX. So if you look through the different indicators with which these models are based on, high yield credit spreads, policy uncertainty, realized volatility, jobless claims, and even the PMI. So quite a spectrum of indicators there, one or two really that are market based, so credit spreads and realized volatility, one that reflects sentiment as per the news in terms of the policy uncertainty one, and then 2 economic indicators there at the bottom, the claims and PMI. Now, the single factor models here that you see, they're based on a regression, and so really that they're showing kind of where, based on the historical best fit, the model thinks that the VIX should be trading based on where the underlying indicator is. Really the bottom line is that on all 1, 2, 3, 4, 5 counts, the level of the VIX, at least at the time of writing this report, was, really kind of materially lower than all 5 different metrics. The better fitting one, which is the realized volatility indicator, even that one, there's a bit of a divergence there. So, that's probably really a key driver of the conclusion that the VIX is prone to spikes at this point. I mean, the other way to think about this kind of chart here is that in some ways it's kind of like a valuation view. So the single factor models are sort of almost like an estimate of fair value, and then the VIX itself, when it moves far above or below where these models are, tends to indicate where there are some opportunities. Now, the one beside it, this is really just my way of saying, look, the VIX is low, equity market volatility is low, but then you look across the various asset classes and it's not exclusive to the equity market. You can see there, so the red line, that's just average implied volatility across bonds, currencies and commodities. So it's kind of like a cross asset implied volatility excluding equities. Now, I have standardized these because, if you look at equity market volatilities much higher than bond and currency, and commodities are also generally higher volatility than them. So for comparison purposes, you need to put them on a standardized basis. Bottom line there is that it's at very low levels. It's not quite at the extreme lows that we saw sort of in 2014, 2015, which actually preceded the beginning of a bit of a period of volatility there. But as it gets lower, if it does go lower, then it's something that tends to add weight to that conclusion that I mentioned before. I mean, it's really based on these 2 charts, but then you also have a look at these 2. They bring in a little bit of extra context. So there's a speculative futures positioning indicator there, which shows that there's quite significant shorts been building up on VIX futures. And, you know, I mean, from a signal standpoint, oftentimes when you get that stretched positioning to the downside, it does mark a little bit of a short-term bottom. If nothing else, it provides at least a little bit of buying power should those speculators be forced to close those positions. And then the other one that I've got here is the assets under management of all the long VIX ETFs in the red and the leveraged long in the darker red. And you know, you can see that it's sort of been maintaining. And if this has been maintaining, then it probably means that investors have been putting money into it, because the natural condition for the VIX ETFs is that the futures roll will tend to eat away at the value of the assets under management because of the negative roll costs, or because of the roll costs that are typically incurred. So, you know, I mean, it just goes back to the point that, you know, there's no free lunch. There's no free lunch in economics, there's no free lunch in markets, so you can't just hold the VIX ad infinitum waiting around for a spike, because, you know, the costs can sometimes be in the order of 10 to 20% a month. So, you know, there's quite a big hurdle. If you're just waiting around betting on the spike, you actually have to be very tactical. So, but, you know, I guess with this, if you saw, like you can see, just in this period in 2016, there was a bit of a build up there, and that actually preceded that spike. And again, later in the year, into the election, you know, when you see build-ups in positioning or build-ups in assets in these ETFs, that, you know, there's probably an element of smart money getting in there. So if you do see that starting to trend up, there's a very, very minor little uptrend there, which I guess adds a little bit of weight to the argument, but not materially. But overall, you know, you look at these four charts, particularly that first one, and, you know, you'd have to say that at this point there's probably a greater chance than usual of a spike, at least from these relatively low levels of the VIX. And so I'll leave it there, and, you know, if you want to have a read into this, or if you want to read into the rest of the report, some pretty interesting stuff in this one actually, particularly in the high yield space. So if you want to have a look at this report, run to the front page there, just to give you a bit of a snapshot. Just get in touch. I'll be putting the link for a inquiry form for this report and for a trial subscription in general. And yeah, if you have any comments or questions, go ahead and chat them in the comments section of the YouTube video, and be sure to subscribe to the channel, as we'll be doing this every week.